Hi, it's John Kelly. In this module, we are going to discuss fraud. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now, you might look at this section and think that it's somewhat contradictory because it's clear in standards that the responsibility for finding fraud is management's and not the auditor's. And it's also clear that the auditor is much less likely to find fraud than to find an error. There are many inherent limitations in the auditor's ability to find fraud. It's often concealed, for instance, so it is unlikely that the auditor will find fraud. And then the section proceeds to list a bunch of steps for the auditor to do to find fraud, even though we probably won't. And of course that's because we would like to find any misstatement in the financial statement, be it caused by fraud or error or an illegal act. We understand that fraud is difficult to find and illegal acts are very, very difficult to find. So even though it's unlikely, we would like to give it our best shot and see if we can't find it. The other thing to remember is we're not looking for fraud. I've kind of misspoken there. We're looking for fraudulent financial reporting. In other words, we're looking for a material misstatement in the financial statement. We're not looking for the fraud itself. And so, for instance, if there's been a theft of inventory, inventory's been stolen, but when the year-end inventory account occurred, that was adjusted. Didn't know why we were short, but we adjusted it. So it's been removed from the financial statements. That is not fraudulent financial reporting, and the auditor is not looking for that. Now, the auditor might observe to the client, gosh, that's an awfully large write-down. You might want to try to figure out why that happened. And the auditor or the client might then find that, oh my goodness, it was stolen. Thanks for pointing that out. We'd not really realized that. But the auditor isn't looking for that. That is not fraudulent financial reporting because the financial statements are not materially misstated. So what are we supposed to do? We are supposed to maintain professional skepticism. And there's actually been a really good document just written, Practical Ways to Improve the Exercise and Documentation of Professional Skepticism. That was produced by Canada and Australia, and you can find that on the internet. Other things we are supposed to do, we're supposed to have a team discussion, partner-led. Not everyone needs to be there, and not a meeting, just a discussion. This is the same as the discussion held in 315, so that discussion can be a single discussion considering both misstatement due to fraud and misstatement due to error. We are supposed to ask management if they're aware of fraud, and we're supposed to get their responses in the rep letter, so the rep letter documents their response and implicitly documents that we asked them. We're also supposed to ask the audit committee, and we can do that in writing in a letter, or we could do that at a meeting verbally and then document that we had done it. And there are other relationships and factors that we might consider. If we do identify a fraud risk, it is a significant risk. And it may actually mean that we need to resign, because if senior management's involved, we may decide that we can't do an audit. So if we do uncover fraud, it's a serious matter. There are some specific responses that we're supposed to have. We're supposed to assign proper staff, and of course we do that, and we're supposed to evaluate accounting policies to see if they can be fiddled with fraudulently, and of course we do that. And we're supposed to be unpredictable. That's in 240A36. And of course we should be unpredictable in the audit. We also have to consider the possibility for management fraud. And we have to consider journal entries, for instance. These are sometimes called topside entries. A large entry is made to accounts receivable at year end. The trial balance, the subledger says that accounts receivable are $100,000. A $900,000 journal entry is made. That hopefully would already have been tested. That's not interesting because it's a journal entry particularly, it's interesting because it's a really big change in accounts receivable, and the auditor would very much like to see some support for it. So we need to consider journal entries. We need to evaluate accounting estimates and perform a retrospective review. And if we come across transactions outside the normal course of business, we need to consider that. Revenue recognition. At the time this standard was written, someone had done a study and found that many financial statement frauds were done through revenue recognition. And it's true that many financial statement frauds are done through inventory and fixed assets and other areas. However, the hot topic at the time was revenue recognition. And so the standard setters picked up on this and said that the auditor is to presume risks of misstatement in revenue recognition. Not material risk, just some level of risk. And it's a rebuttable presumption. If you rebut it, you would document why. And perhaps analytical procedures done at the planning stage cause you to believe that there is no particular material risk of misstatement due to revenue recognition. A30 actually gives an example of a situation where there is no risk, not just low risk. Risk of material misstatement is 0. And that's actually a rental of an apartment building. They say there is no risk of material misstatement and revenue recognition there. So it needs judgment. Some auditors have responded to this by deciding that the risk of material misstatement and revenue is always high, and that's clearly incorrect. Professional standards tell us that that's wrong. A30 says that that's wrong. So don't do that. That means we're going to do too much work, and if we're auditing away for fraud when there really is none, we're going to waste time and be inefficient. Now, documentation here is particularly important. If there is fraud, we're probably going to miss it and not find it. So we very much would like to document that we've complied with professional standards. So if someone says, hey, you missed the fraud, we say, well, we did our audit in accordance with general accepted auditing standards, and that's all that can be expected. So what do we document? We document that the team discussion was held, and that's the same team discussion in 315.32a. We document that we considered the risk of material misstatement of fraud at both the financial statement level and at the assertion level, and then that's the same as 315.32b. We document our responses to the risk of material misstatement of fraud. That's the same as 330. We would communicate with management if we found fraud. And the rebuttable presumption about revenue fraud, if we decide it's been rebutted, we should document that we think it's rebutted and why, probably analytical procedures. So, thanks for listening.